Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at 3 strong buy retail stocks to consider buying for the upcoming holiday season and perhaps holding for much longer than that. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 retail stocks, it's worth noting that the market had a significant pullback as of morning trading on Tuesday, with the Dow down about 1.3%. The S&P 500 was down 1.9%, and the NASDAQ pulled back 2.6%. So a big pullback, which followed some positivity to end last week after we started last week with a huge downturn as well. This kind of highlights what we could see throughout the rest of 2021 heading into the new year, which could be some volatility. And obviously analysts and traders have been calling for a significant pullback, if not a correction, for the last several months, especially since that mid-July pullback got wiped out and we continue to go to new highs throughout 2021. So we could see more volatility. With that also in mind, bond yields hit 3 months highs Tuesday morning as well. And this comes amid growing speculation on when the Fed is going to start paring back its bond buying and then when it's going to finally start raising those interest rates. With that all said, even when the Fed does start to lift its interest rates, it looks like, especially with inflation, that the interest rate environment will continue to favor stocks, as people are just going to want returns that are far above what these 10-year Treasury yields and even 30-year Treasury yields can provide. With that said, there's obviously rising price concerns, inflation worries, all of that is going on as well as we head into the holiday season. With that said, though, the overall earnings picture remains strong, even though we've seen Q3 estimates slow down in terms of their positive revisions higher. That said, also, the margin picture for 2022 and 2023 for the S&P 500 suggests that maybe the inflation won't be as bad, and it could be, as Powell has said multiple times, that it could be more transitory than we even see at the moment. Obviously, we will have to wait and see with that on that end. But in terms of the 3 retail stocks we're going to talk about today, heading into the holiday season, we saw some strong August retail sales that came in far above analyst expectations and marked a dramatic turnaround from July's bit of a pullback, and obviously showed that the Delta variant hopefully won't stop a strong holiday shopping season, which is now rapidly approaching as we head into October. So with this in mind, we're going to take a look at the first of the 3 strong buy retail stocks we're going to look at today, and that is Yeti Holdings Incorporated, which trades in the ticker Yeti, Y-E-T-I. So we're going to go into what the company does and then look at some fundamentals from there. So the Austin, Texas-based firm began selling its white heavy-duty coolers that can hold ice for roughly multiple days, roughly 15 years ago. Yeti's journey from helping commercial fishermen and food trucks and countless other outdoor activities that rely on keeping ice cold for a long time, turning all the way into a billion-dollar retailer, is really a case study in a combination of functionality and successful brand building. Yeti grew its customer base for its rugged, reliable, and simply branded coolers that can cost up to $1,300 by expanding its portfolio far beyond those now iconic white and massive coolers. Today, the company sells an ever-growing array of styles, sizes, colors. On top of coolers, Yeti also sells multi-purpose buckets, gear boxes, outdoor chairs, dog bowls, and other Yeti-made and branded offerings. The star of its expanded portfolio is also its drinkware unit, which includes tumblers, mugs, bottles, jugs, and much more, with drinkware accounting for nearly 60% of its total revenue last year, a trend that's continued so far in 2021 as well. Yeti's also ventured deeper into the bags market. It's selling more luggage, backpacks, duffel bags, and Wall Street is certainly starting to focus more on Yeti's opportunity to compete in the newer age, upscale bag market against the likes of Away and other popular, more expensive bags. Yeti's also a mainstay now, from boats and trucks and campsites to backyards to car cup holders to office desks. So it's really become a much more diverse company. And as we mentioned, that drinkware business is a huge, huge part of its growth recently. The company's growing stable of products helped its sales climb 20% last year to $1.1 billion, with its direct-to-consumer revenue up 50% to account for nearly half of its sales. Yeti's direct-to-consumer growth outside of its wholesale business, which includes the likes of Dick's Sporting Goods and other outdoor-focused retailers, and even places like Walmart and stuff like that, along with its e-commerce, has slowly helped it grow, and it's also growing its own small brick-and-mortar business beyond its flagship store in Austin. The company has locations in Denver, Charleston, and a few others, and it's continued to cultivate that brand, which has seen many knockoffs and similar-looking products enter the market, trying to undercut them in price, but it clearly hasn't affected the company so far. The company most recently crushed our second quarter 2021 estimates with sales up 45%. The top-line expansion marked its highest as a public firm, edging out Q1's 42% growth. Meanwhile, its adjusted earnings jumped 66%, and its gross margin came in at about 58.5%. And if we look back just 3 years ago, that margin sat at 42%. So that is really impressive. Yeti's e-commerce segment also continued to grow really significantly. That's helping it boost those margins, and its wholesale unit also continues to do well as well. So obviously, with 45% sales growth, the business is sort of running on all cylinders. The company is also investing in modernizing its back end and supply chain efforts. This includes obviously that beefed up e-commerce business, and the company's international space is still very small, but it continued to post threefold growth last quarter, the same as it did in the first quarter. So now looking ahead, Zacks estimates are calling for its full year 2021 revenue, so fiscal 2021, to climb 28% from about 1.1 billion all the way up to 1.4 billion, with then another 16% growth expected in 2022. And then on the bottom line, we're calling for about 33% growth this year, and then another 18% growth next year. So the 28% growth this year would come on top of 20% growth last year, 17% growth the year before that. So those are the first 2 full years as a public company, really solid out of the gate. And then we've also seen the company have some strong positive earnings revisions higher since that last earnings report for both fiscal 2021 and 2022. We should also note that management upped its guidance, and it's prepared to continue benefiting from strong consumer spending. This is highlighted by continued pent-up demand, especially among higher income households who can afford Yeti's products, because obviously people who are willing to spend $40 on a mug or easily $300 plus on a cooler are the people who have continued to thrive despite all of the coronavirus economic setbacks. Obviously, there are global supply chain worries, but Yeti management remains pretty confident that they can navigate them. When they last talked about that in their second quarter earnings call. The company is also part of the Zacks leisure recreation products industry that sits in the top 10% of over 250 Zacks industries. This includes fellow highly ranked stocks that are all benefiting from, as we said, this continued pent-up demand of people wanting to spend money on things that make them happy, such as golf clubs and Yeti coolers. Yeti stock has soared about 90% in the last 12 months. This crushes its peers group. 10% climb, and this is part of a roughly 420% run since its public debut in late 2018. That said, the stock has pulled back recently. That included an over 4% decline the last time I checked on Tuesday morning. The stock's now down around 17% from its August highs, and the pullback has pushed it pretty much lightning quick into oversold RSI levels. It's at 28, so anything below a 30 is considered oversold. And it was sitting well above 60 not too long ago. So the quick downturn could see people jump right back into Yeti stock, as it's now down 17% from those August highs. That said, the pullback has also made its valuation picture look a little more enticing. It's trading at 34.3 times forward 12-month earnings, which comes in well below its highs for the year and right around its year-long median. We should also note that Yeti's positive earnings revisions help it grab that Zacks ranked number 1 strong buy right now. And Wall Street remains really high in the stock, with 8 of the 13 brokerage recommendations that Zacks has sitting at strong buys, with none below a hold. So not only has the stock pulled back significantly recently, so it could be could be ready to bounce back pretty soon for anyone who's considering as a more near-term 2021 holiday season play, but also the stock could certainly be a longer-term play with the growth we've already seen, especially as it continues to expand its reach, as we mentioned, into bags, and its drinkware business is continuing to do very well, and we see that margin growth expand and expand and expand. So Yeti is the first of these three stocks, and it's certainly worth considering now and going forward. We're going to move on to a totally different stock that's been established for much longer, and it sells a completely different set of products, and that is Best Buy, which trades under the ticker BBY. So obviously Best Buy benefited from that early coronavirus remote schooling, remote work push. That could obviously put the company under pressure in 2021, which is actually its fiscal 2022. So we'll see that in a second. But overall, the company sells smartphones, TVs, connected appliances, and nearly really every other consumer electronic device you can think of. And in an age where everyone's addicted to consumer electronics and TVs and smartphones, that's a good business to be in. As we mentioned, that they benefited from that remote work environment, and they could continue to benefit from that as more and more people are establishing permanent home offices, or at least a hybrid work from home some days, work from the office some days. So you need more tech gear on your side. So Best Buy's revenue climbed about 8.3% last year for its best top line expansion in 10 years. Meanwhile, its earnings jumped 30%. We should note that executives said last year online sales made up about 43% of total Q4 revenue. And the CEO noted at the time that its stores played a pivotal role in fulfillment of these sales, with as almost 2/3 of their online revenue were picked up either in stores or curbside, shipped from stores or delivered by a store employee. So they're not going to have to continue to spend on building out warehouses or anything like that. So companies like Target and Best Buy have found this e-commerce and pickup delivery to be very successful, just running them out of their actual physical locations already. More recently, Best Buy joined the likes of Walmart and other retailers in setting up a subscription service. Best Buy announced in early April that it was piloting a new membership program that it called Best Buy Beta. The $200 a year service includes member pricing, unlimited Geek Squad technical support, up to 2 years of protection on most products, free standard shipping and delivery, and free installation on most products and appliances, with some other perks as well. That offering is now called Best Buy Total Tech, and it's set to be possibly a pretty big hit going into the holiday season and going forward. We'll see if people are willing to pay that $200 price tag for a membership that's giving you kind of those same things. But if you go on their website, this is what you'll find out. It's up to 24 months of product protection on most Best Buy purchases, including Apple Care Plus, free delivery, standard installation on all eligible Best Buy purchases, free Geek Squad tech support available, what they're calling 24/7, 365. So that can be huge for people who are maybe not as tech savvy. VIP access to dedicated phone and chat teams, and the list goes on and on and on. And you have extended 60-day return and exchange windows on most products, which could be huge for a lot of people, especially heading into the holiday season. So with that in mind, the company most recently topped our Q2 earnings in late August and raised its FY 2022 view. That's their current fiscal year. Its revenue climbed 20% and its adjusted earnings climbed 75% last quarter to top our bottom line estimates by over 50% for the second quarter in a row. So with that said, the company's full year revenue are expected to climb about 10% all the way up to about $52 billion, with the adjusted earnings expected to climb about 26%. So that's on top of really impressive growth last year. That said, looking ahead to fiscal 2023, we're calling for a bit of a slowdown on the revenue growth and the earnings growth side as they come up against two really difficult to compare against years. With that in mind, though, the company has continued to see upward earnings revisions trends, not only right after the report, but more recently in the last 7 days alone. So analysts are continuing to be more positive on Best Buy in terms of that earnings growth, and they've continued to beat our bottom line impressively the last 2 quarters. So maybe by the time they report their third quarter results, we could see more positivity for next year. With that in mind, the company has moved relatively sideways over the last year. The stock's actually down about 1.5% in the last year, which trails that retail consumer electronics market, which is up about 30% over the last 12 months. That said, this stock has done really well over the last 5 years. It's up about 190%. This easily tops Walmart, the S&P 500, and that industry. So at $108 a share, the stock's currently trading about 15% below its records, and at 11.4 times forward earnings, it's trading 30% below its year-long highs and around 20% below its median, and at a nearly 50% discount to its retail consumer electronics industry that sits in the top 10% of over 250 Zacks industries. So that right there may be enticing enough for some investors to consider it. On top of that, the company has a dividend yield of about 2.6% at the moment, which comes in well above the recently climbing 10-year U.S. Treasury, well above the S&P 500's average, well above the likes of Walmart, actually a percentage above Walmart's 1.6% dividend yield. The company's also repurchased more than $2.5 billion worth of its own stocks so far, which came in above its prior outlook that called for approximately $2.5 billion. So it's already purchased more of its own shares than it was expecting to, which is another way to return value to shareholders. With that said, Best Buy's earnings revisions activity, as we mentioned, that turned even more positive recently, helps it land a Zacks ranked #1 strong buy at the moment, alongside A grades for both growth and value in our style score system. So therefore, investors might want to consider Best Buy heading into the holiday season, despite broader global supply chain worries. And not only for the holiday season, but like with Yeti in the next stock we're going to talk about, worth considering now since it's on the big dip with a strong dividend yield. So maybe it's worth considering as a longer term play, as everyone's addicted to those consumer electronics that Best Buy is selling. And now we're going to close out with Tempur Sealy International, which is TPX. This is the mattress giant. It's benefited from the coronavirus economy, that booming housing market. And even though the housing market's cooled down just a little bit, more people continue to relocate and reevaluate where and how they live. Millions of people are updating their homes, their apartments, buying bigger homes, moving to the suburbs, buying second homes. And all of this has really benefited the mattress firm that traffics in the luxury side of it, aside from like the really high-end mattresses that some people probably have never even heard of. I've looked at some of these high-end mattresses that cost like $50,000. Who knows the people that are buying those? But the average person would consider Tempur Sealy to be on the higher end, more luxury focused mattress. The company operates 3 different businesses. So the company has the Tempur Sealy or Tempur-Pedic, Sealy, and then the Stearns and Foster brand. The company also offers some values-focused private label and OEM products, and the Lexington, Kentucky-based company sells mattresses, pillows, and more under all of those various brands. And we should note that the company was the #1 ranked in terms of J.D. Power's U.S. mattress satisfaction report for the second year in a row in 2020, which is really important. I mean, more and more people are considering how much sleep is valuable to them, and they're willing to pay for various brands and models and things that Tempur Sealy sells that might help them sleep better. The company sells adjustable beds and mattresses that provide cooling and other high-tech capabilities. They're even rolling out beds that try to help reduce snoring, which can be very detrimental to people's sleep. And obviously, you spend a lot of time sleeping, so it's not going out of style, and people are certainly willing to spend a lot of money on beds. We should note that the company has invested in its direct-to-consumer and digital channels like every retailer and every business in the Amazon age. This is helping it fight back against any encroachment from those newcomers and bed-in-the-box firms like Casper. Obviously, they own their own stores, and they work with third-party retailers like Mattress Firm as well. And we should note that the company in August completed its acquisition of a leading specialty bed and mattress retailer in the UK, which is called Dreams. It's expected to nearly double sales through its international segment and significantly boost its direct-to-consumer revenue. Wall Street's shown its love for the deal and its blowout second quarter financial results that it reported at the end of July. So continuing to expand its reach, that Dreams deal could prove rather significant as it tries to expand, as I said, outside of the U.S. in that international market. As we quickly mentioned up top, the Mattress Giant posted a strong pre-pandemic growth. Actually, I don't know if I mentioned that, but it's not just the one-hit COVID wonder recently. Fiscal 2019 revenue was up 15%, and the first quarter, which happened before the pandemic really took hold, sales were up 19%. So it was doing really well heading into the pandemic to give people a sense of their outlook going forward. So last year's conditions were obviously ideal, driven by all those things we talked about: home buying, increased home focused spending, helped its revenue jump about 19% to about $3.7 billion. And we should note that the company boosted its guidance on the back of improved industry conditions and that Dreams deal. So Zacks estimates now call for its 2021 revenue to surge 36% to reach $5 billion, with it expected to boost its adjusted earnings by 69% to $3.23 per share. It's then projected to follow up this strong showing with another 10% revenue growth in 2022 and 13% stronger earnings. So 3 big years of growth in a row for this mattress and bedding giant. Analysts also quickly and sharply raised their FY 2021 and 2022 adjusted earnings outlooks, with their consensus estimates up about 15% since its last report. The post-second quarter release revisions are part of continued revisions higher on the bottom line over the last year plus. Along with its growth, company executives rolled out initiatives aimed at returning more value to shareholders. So last November, it completed a 4-for-1 stock split to help make its share price more accessible to a broader swath of investors. Management also at the time announced plans to initiate a quarterly dividend in 2021 and increase its buybacks, of which it's done both so far. It paid a 7 cents per share dividend in the first 2 quarters of 2021, and then it boosted that payout by nearly 30%. Its dividend yield sits at about 0.7% at the moment. So nothing fantastic, but an added bonus for a stock that's done pretty well. Given this backdrop, it might not be shocking that TPX stock has skyrocketed about 130% in the last year to crush the S&P 500 and the retail home furnishing market, which includes RH, Ethan Allen, and others, which has also gone an impressive 80% run. That streak's continued over the last 3 months, with the stock up around 25%, while its peers have cooled off a bit more. So the stock has outpaced that 7% climb. That said, the company touched new highs of, obviously that includes their 4-for-1 stock split, but new highs of over $50 a share last Thursday. And it, at the time when it hit those new highs, it climbed into overbought RSI territory, which is 70 or higher. It hit all the way to 78, but it's pulled back since then, including on Tuesday. It now sits around $48 a share, and its RSI already fell back to around 60. So it's cooled off a bit, which could be good for investors who might have missed out on this big run so far. That said, despite trading still within range of its new highs, it's trading at a nearly 20% discount to its industry at about 14 times forward 12-month earnings, which also comes not too far above its own year-long median and 15% under its own highs. So despite trading with its stock price and new highs, its valuation looks really strong. And like all the stocks on this list, it is a Zacks ranked number 1 strong buy right now. And Wall Street is rather high in the stock, with 6 of the 9 brokerage recommendations that Zacks has coming in at strong buys. We should also note that the furniture space sits in the top 14% of over 250 Zacks industries. So all 3 of these retail stocks could not only benefit from continued strong spending on the home front side, especially heading into the holiday season, and all of their industries are really strong at the moment. So they're all worth considering for both the near term, despite what could be some volatility, and longer term trends, especially TPX's sleep's not going out of style. So certainly worth considering all 3 of these Zacks ranked number 1 a strong buy retail stocks. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. Remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.